What's up, my Financial Fit fam? Adam here, and thank you for coming back as always. You know, every expert and YouTuber will predict that the next stock market crash is coming, but when? I mean, for the past 3 years, we've heard about this bubble, and the bubble's about to explode, and yeah, we've seen setbacks, but the truth is these setbacks only set us up for comebacks. The stock market's currently sitting at all-time highs. Meanwhile, just 10 months ago, it was trading at 60% today's current value. So was that the big drop-off? Or is there more pain yet to come? So in today's video, we're going to cover some of the previous stock market crashes, what caused them, and will the next big one happen in 2021? So let's get going. Well, there is one thing I can promise will never crash, and it's this YouTube channel. So if you're liking the content of this video and some of the others that we've made, make sure to hit the like button, and also don't forget to subscribe to this channel as it helps build a following. What's the difference between a stock market crash versus a general market decline? The crash implies a dramatic, steep, off the cliff dropping of stock prices across all major markets, and as a result, you see a major decline in wealth. Even in a crash, a well-diversified portfolio will take a hit because there are sectors that bring down the entire market. It's kind of like someone that goes against the Italian family and they're going to be swimming with the fishes. So they tie that cement block around their ankles and all of a sudden they're down at the bottom of the river.
Louis Brazzi sleeps with the fishes.
Luca Brazzi. Luca.
Whatever.
These stock price declines are caused by wild speculation and extremely high stock prices compared to their intrinsic value. And when we're talking about intrinsic value, we're looking at things as far as revenue and earnings. Poor economic conditions or an economic downturn combined with fear will cause panic selling. That drives the stock prices down even lower. There are certain conditions that do increase the likelihood of a stock market crash. The first of which is prolonged rising stock prices. The second would be this complete euphoric feeling around the stock market. The third is when the price to earnings ratios become excessively high and they start to exceed their previous year's averages. And then lastly is when there's large amount of debt or margin that is being used by market participants. Now in a stock market crash, we're looking at a decline of 10% or more within a very short time frame. That's normally one day up to a couple of days. And just because the market crashes does not necessarily mean that a bear market will follow along with it. A bear market is a sustained market decline associated with a 20% drop off from the recent highs and with a continuation of a downward trend. In a bear market, we see elevated unemployment and we also see a complete economic slowdown. So again, just because there's a stock market crash doesn't mean there's going to be a bear market, and not every bear market starts off with a stock market crash. The first market crash we're going to look at is the market crash of 1929. And this was the time of which we had large technological innovation happening. We had things like cars, planes, and radio, just to name a few that were really becoming popular at the time. Now during this time, margin debt became widely popular. People would borrow money from the bank or from their brokerage and would purchase securities and other investment vehicles using debt. Now this put extra pressure on the stock market. Over the 8-year period from 1921 to 1929, the stock market was booming, and its value increased sixfold. Now in 1929, the economy actually began contracting, and a major sell-off followed. People overextended themselves by using debt to buy securities. And then basically, they got their hand caught in a cookie jar. After a brief bounce back, the stock market lost over 90% of its value and led to the Great Depression. I know I told you before that a stock market crash doesn't always lead to a bear market. In this case, well, it did. It took the stock market over 25 years to bounce back and create new all-time highs. The next market crash we're going to look at is the one that occurred in 1987. And most people refer to it as Black Monday, but the truth is that market decline actually started 4 days prior on October 14th. However, on Black Monday, the Dow fell 22.6% and all other markets followed suit. Not only were markets crushed here in the United States, but in the late 1980s, we were shifting more towards a global economy. So the markets in other countries also felt the pain. The good news was the pain was short-lived and there were several days that the market did bounce back. And in less than 2 years, we were able to recoup all of our losses and create new all-time highs. Although the causes of the 1987 stock market crash are unknown, we are on a multi-year bull run, and the PE ratios of a lot of these stocks were excessively high compared to its previous year's averages. With the 1987 crash came some good news, and there was something implemented called the trading curve. And now whenever prices or equities fall by 7% or more, there are freeze periods that are automatically triggered by the market. This allows for 15 minutes to cool off and the panic to subside before trading is to continue. In more recent times, we saw the crash of 2008, which led to the fall of Lehman Brothers and the demise of Merrill Lynch because of their exposure to subprime mortgages. And don't forget Bear Stearns. The 2008 decline was much more prolonged than the crash of 1987. But with banks failing, the entire global financial system was literally one step away from an absolute, complete, utterly disastrous meltdown. During this time, trading volume was sky high and there was immense amounts of selling pressure. We experienced several days of greater than 7% losses. In 2015, the Shanghai Stock Exchange fell by more than 30% in less than 7 days because of the fear of a slowing economy. Even in more recent times, just 10 months ago, we experienced the 2020 coronavirus crash, obviously caused by an increase in COVID-19 cases. We had a travel ban. There was an oil price war at that time. There was also a fear of an incoming recession. Between March and April of last year, it seemed like the stock market would not stop dropping. Well, the Federal Reserve turned the interest rate all the way down to zero, and we imposed an economic stimulus bill of $1.5 trillion. This helped stabilize the markets and actually brought the market back to pre-pandemic levels. And now, who would have thunk it, we find ourselves at new all-time highs. That's all well and good, but where are we now? How risky is this current market? And the only way to truly understand that is to look at some of those previous contributing factors and compare it to what we're experiencing today. The first factor is speculation. And this happens when you take a chance on a company that is high risk. Now, that downside risk is generally tied to a potential significant gain. Usually these are newer companies that lack positive cash flow and lack credibility. As an example, we're going to look at stock IZEA. It's trading up over 1,980% on the year, and it was trading at just 14 cents back in March. Now, this company's market cap is around $340 million, but their revenue over the trailing 12 months has been $17.7 million, and they're not profitable. There's no growth in revenue, there's no growth in earnings, but for some reason, this company has been on a tear. Makes no sense. So is this current stock market speculative? Yeah. Another factor is a prolonged rise in stock prices. For the past 11 years, we've been on this crazy bull run. Yes, we had a small hiccup back in March, but is that going to be the only hiccup? Could the market change direction? All those scenarios is possible. So are we in a prolonged stock price climb? Yes. So to keep score at home, we're 2 for 2. The next factor is the euphoric feeling in the stock market, or as the kids would say, the good vibes. Everyone is putting their money to work in the market, and that's what you want to do. But when everyone is doing it, and the herd is making a ton of money because the entire stock market just keeps going up, that's when the market becomes the most dangerous. Euphoric feeling? Absolutely. The next factor is a high PE ratio. And if we look at the S&P 500 as a whole, the current PE ratio sits at around 34.24, which is well above its 10-year average at around 19.8. So yes, those PE ratios currently are high. However, they are nowhere near the PE ratios of 2008-2009, as the S&P 500 PE ratio reached over 122. So while this PE ratio is elevated, I'm going to give the current level of the PE ratio a neutral rating, or as we would say back in the old country, Mez. The last factor is high margin debt. And there was a report that came out in December of 2020 that showed that marginalized debt is at its highest point it's been in over 2 years, with over $722 billion borrowed against people's portfolios. This is up 28% since 2019, and it has more than doubled since just 7 years ago. Marginalized debt on the rise? Check. That means 4 out of 5 indicators would suggest that this market and this market condition is currently high risk for a market crash. Currently, the market is at a high risk level, but it doesn't mean that there isn't money to be made in this market. Exercise caution and invest wisely. Right now, the high tide is raising all ships, but that might not be the case in the near future. It's important to do your own research on any investment you make. And if you don't feel confident, we've created a video around the basics of doing your own research. And that link should flash above, and you can also find it in the description below. Using the strategy of dollar cost averaging as an investor can help you weather a storm if a stock market decline is ahead. Is a stock market crash coming? Yes. When? I have no clue, and don't let anybody else tell you otherwise. Unless they're Michael Burry. As always, save, invest, and grow. Ciao, ciao.